Chapter 20, Accounting for Leases. This chapter covers various objectives including classification of leases, advantages and disadvantages of leasing, accounting for lessees operating on capital leases, accounting for lessors operating direct financing and sales type leases, and cash flow presentation and disclosures by lessor and lessee. First, here is a quick overview of commonly used terms in the chapter. Lease. A lease is an agreement governing the right to use property, plant, or equipment, usually for a stated period of time. Lessee versus lessor. Lessee is the borrower or the user of the asset, and the lessor is the lender or the owner of the asset. Operating lease versus a capital lease. Operating lease is usually short-term and allows the lessee to use the leased property for only a portion of its economic life. A capital lease is usually longer term and effectively transfers all the risks and rewards of the leased property to the lessee. It is equivalent to a sale with financing arrangements. GAAP requires that the lease is considered to have transferred the substantial risks and benefits of ownership if it meets any one of the 4 capitalization criteria. These criteria include: 1. The lease transfers ownership of the property to the lessee at the end of the lease. 2. The lease contains a bargain purchase option. 3. The lease term is equal to 75% or more of the estimated economic life of the leased property. And lastly, the present value of the minimum lease payments is equal to 90% or more of the fair value of the leased property to the lessor. The lease is categorized as an operating lease if none of the 4 criteria is met. And in that case, the lessee simply recognizes rent expense each period. If the lease is classified as a capital lease, the lessor will account for it as either a sales type capital lease or a direct financing capital lease. A sales type capital lease results in a manufacturer's or dealer's profit or loss that is recorded by the lessor. A profit or loss exists when the fair value of the leased property at the inception of the lease is greater or less than its cost or carrying value. In a direct financing lease, there is no manufacturer or dealer's profit. For the lessor, the lease is an operating lease only if the lease meets none of the capitalization criteria or fails one of the recognition criteria. In this case, the lessor does not recognize a sale or a receivable, and the leased asset remains on its balance sheet. Please refer to the textbook for additional details on leases. Another important factor is the discount rate. The lessee computes the present value of the minimum lease payments by using the lower of either the lessee's incremental borrowing rate or 2, the lessor's implicit interest rate in the lease, if known by the lessee, and or if it's practicable for the lessee to learn. How do we amortize a leased asset? The leased asset may be depreciated over the economic life of the asset or the lease term. The lessee depreciates the asset over its estimated economic life to its estimated residual value if the capital lease agreement either transfers ownership of the asset to the lessee or includes a bargain purchase option. If the capital lease does not transfer ownership of the asset to the lessee and does not include a bargain purchase option, the lessee depreciates the leased asset over the lease term. Because the lessee's rights to the use of the asset ceases at the end of the lease. Reduction of the lease obligation. Because the lessee records a liability, it computes interest expense and the reduction of the principal for each lease payment using the effective interest rate method. This method computes interest expense each period by applying the discount rate, that is, either the incremental borrowing rate or the implicit interest rate as appropriate, to the outstanding balance of the lease obligation at the beginning of each period.